Hello, passive investors. Welcome to our exclusive deal review webinar. I'm your host, Jim Pfeifer. Today's episode is part of our special deal review series, where we bring syndication deals to a panel of experienced limited partners to analyze and discuss. The goal? To equip you with the tools and insights to confidently step into passive real estate investing as a limited partner. One of the best ways to do that? Reviewing deal after deal after deal to understand what separates a great investment from a bad one. Today, we've invited Nick Stonestreet and Drew Weinstein from DLP Capital to present one of their latest deals. Nick, Drew, thanks for joining us.
Thanks for having us.
Thanks for having us, Jim.
And joining me on the LP panel are experienced LPs Paul Shannon and Chris Lopez. Paul, Chris, great to have you here.
Thanks for having us.
Thanks, Jim.
Together, we're going to break down the deal, ask the tough questions, and expose any red flags we see. If you're a passive investor looking to sharpen your skills, this is the perfect chance to learn from the experienced LPs and gain insights for your own investing journey. Here's a review of the format. Nick and Drew are going to have about 10-15 minutes to highlight their fund. We've asked them to just do a highlight because we're assuming that everyone watching this has a handle on DLP's track record, that you've reviewed the deal and you've watched the webinar. After that, the LP panel will pose questions to Nick and Drew for the next 15 minutes or so. Then we'll let Nick and Drew go, and our panel will discuss the deal amongst ourselves. As a reminder, this is called passive investing, but your work begins with evaluating all of the underlying documents and information. This webinar is intended to augment that and help you figure out how to analyze a deal and question a sponsor. So let's get to it. Nick, Drew, I'm going to turn it over to you for 10 minutes of highlighting your deal.
Thanks for having us. We're glad to be able to present, talk a little bit about DLP. Just quick background on me. I've met Don Winter, a founder of DLP, about a year and a half ago. And I was running a portfolio of about $20 billion for a trust company and was the CEO and CIO. And so I actually met DLP when I was diligencing their funds. So my background has been more in investments and financial services, wealth management, literally all over the world, running banks and wealth management institutions. I found the story behind DLP so compelling and what Don's doing here so compelling that I joined. Drew, you want to give a quick background and then we'll jump into the deck?
Yeah. Drew Weinstein, Director of Institutional Capital Partners here with DLP. My career has been over the last decade in the form of private equity, private credit, capital raising, and investor relations. That is primarily my background. For the last 5 years or so, I've been within the real estate capital markets, specifically raising capital as well as managing investor expectations in terms of what they can expect regarding various investments on both the credit and equity side. I've been with DLP now for just almost about 2 months, so relatively new, but again, not new to the space. And my purpose for really coming over to DLP Capital was because I saw this amazing performing fund out there with an amazing track record for the last 10 years. And I said, you know what, if they're not seeing the stress in their portfolio today, given the more macro backdrop that we're seeing across the broader asset class, they got to be doing something right. So here I am, happy to be here, and great to spend the time with you guys. And I'll pass it to you, Nick.
Yeah, just quick on our founder, Don Winter. Don was basically started DLP a little over 18 years ago and started flipping houses in his native Pennsylvania, and quickly grew that business and started doing more and more multifamily. Started the fund in 2014. So the fund's now got a 10-year track record, the lending fund, the one we're discussing today. And one of the things that attracted both Drew and I to DLP is the culture. You can see Don and his family. They're always around great people, wanted not only really do a great job for their investors, but also for their community. If you've been on the webinar, you know the story. This is one that it's really been great to see what Don's been able to do. This is one of the deals we just did with a sponsor there in Pennsylvania, really going back to his hometown and his hometown roots in Bethlehem, Allentown area, and building into his community there. Most of our portfolio is in the southeastern United States, kind of Sun Belt, Texas and Sun Belt. But we do have some in Pennsylvania as well that we do. And the mission at DLP is to build thriving communities. That's really what we want to do, not only to have successful outcomes for our investors, but we think one of the ways we achieve successful outcomes for our investors is by taking care of our residents and pouring into them. We believe that by doing good with our residents, that we're able to keep them in the communities longer, that we're able to lower maintenance costs. A lot of other good things happen when you treat your residents well. You can see by the numbers, DLP a little over $5 billion now that in the funds, and a good track record. So when we talk about thriving communities, there's different ways that we look at that, but it really is looking into the community and trying to do good and to keep consistency with our residents using 2-year leases, other means to keep them in the communities longer term by really taking care of them and pouring into them. A couple of the things here at DLP, it is a driven culture. So to be very clear, everybody shows up here locked in every day. It's not for the faint of heart. We're growing fast and we're building a culture of people that want to be here and achieve. Part of that's living fully. How we define that is by people engaged in every area of their lives. We want to pour into our employees just like we want to pour into the residents. We're doing some other things as well at DLP Capital. Aside from the funds that we're talking about, we also have a DLP Bank and our Positive Returns Foundation where we really look to do good in our communities as well.
So just talking about DLP Capital as a whole and the sponsored funds, I know we're talking specifically about the lending fund, which is all the way on the left side, but I wanted to just give a holistic view as to where DLP falls within the asset class today. So lending fund, this is more senior secured positions. All of these are open-ended REITs, I want to just add. But senior secured on the lending fund side of things, this is where you're going to have the least amount of risk within your position. Right after that, we do have a preferred credit fund that's focused on more of the preferred equity and mezzanine financing positions, which has a little bit more risk, right? Sitting in second position, as well as the pref side of the capital stack. And then all the way to the equity side. And I want to highlight this because falling on within our DLP housing fund, this is more value add type strategies where you're looking for a higher return, but you're also sitting lower within the capital stack, right? In an equity position, as well as the building communities fund, which is focused on more of the ground up equity side of the capital stack. So we are sitting in the equity position within that fund, but purchasing land, getting it entitled, permitting, all the way through construction and then stabilization of the asset. So what that brings is an extremely well-rounded analysis and approach internally for us as to whichever seat we're going to sit in within a capital stack, if it's on the debt or equity side of the capital structure. We have an extremely well-driven or underwritten analysis that we can put together to ultimately decide, is this loan viable for the fund or not, right? Is this acquisition viable for XYZ fund or not? This is going to be focused primarily, as was mentioned earlier, on the DLP Lending Fund. So I do want to stick with that focus here. So what are we looking at in terms of lending criteria? We're focused on high-end assets, right? We're looking at some of the greater MSAs across the United States, specifically within the Sun Belt and Texas. So we're looking at verifiable track records with borrowers, as well as the asset type, right? A great asset. Have they done multifamily before? Do they have a 10, 20 plus year track record delivering multifamily to the United States and specifically within the regions that they're looking to build in? Again, touching on the quality locations, right? We want to focus primarily on the Sun Belt and Texas regions, going all the way up to Pennsylvania. You can see we've done some in the Midwest as well, but really preferred markets are going to be areas where the population is growing. There is a substantial amount of income within families, places where they can't afford the rent, as well as, families that are looking to meet affordable income ratios, right? So can they actually afford the rent that's being charged in certain areas and the like, right? We don't want to push anyone out of a specific area from affording the rent. DLP Lending Fund. So just to give a quick highlight, we have paid $163 million in distributions to investors since inception. The theme here is consistent growth. If you're looking at a chart, we want to mimic the up and to the right format. Our goal, as Nick mentioned, right, a meaningful impact on America's affordable housing crisis, right? We want folks to be able to afford the rent. We want them to be happy where they're living, and we want them to stay.
One of the ways that we look at that is area median income, right? Right now, our portfolio is right at about 25% of AMI. AMI gives you a really good indication of whether somebody can afford the rent. As Don always says, people can afford the rent. Guess what they do? They pay the rent. So it's always a good attribute.
That kind of goes into our mission and overall strategy as well, right? Which is that if folks can afford the rent, they pay the rent, that attributes to income to our investors and a better NOI at the end of the day for the individual asset, not just the fund. That's all part of our strategy here. The investments that we make, they're all debt investments within the lending fund. Again, senior secured positions for ground up construction and even mid construction, as well as bridge lending within this vehicle.
One thing I wanted to mention, sitting on the investment committee, when we look at committing capital to a sponsor, right? One of the things that I always think about in any deal is, what can go wrong? That's just the job of, when you're a chief investment officer or when you're on an investment committee, you need to be, a paid skeptic, right? So one of the things that I really like with the risk analysis with DLP is, we're vertically integrated. So when we're looking at lending to a sponsor, it's got to be a deal that we really like. And if we ended up in a scenario where we had to step in, we could finish the project. We could stabilize the project. We could sell it or we could keep it in our housing fund. So that's one area that, to me, when I was evaluating DLP, provided a substantial safety net to investors, was the way that we could deal with issues in a comprehensive way because we have the vertical capabilities in the company.
Yeah, and that's a great highlight because not many of our competitors do have an actual in-house construction team that runs a full constructability analysis of the asset or the project, before we actually make the loan, close it, and actually start funding the draws on those projects. Highlighting a little bit about the fund itself and our September performance. So the compounded performance, the net total return, right, since inception is going to be just over 13%. You can expect an annualized average return of just over 12%. That's based since inception. We are targeting 9 to 10%. So when you think about this lending fund, right, again, senior position, we're not out to hit home runs. This is a singles and doubles type of fund. We want consistent performance and we want consistent yield delivered to investor capital accounts. So we are targeting that 9 to 10%. The annual preferred return of 8%. There's a 2% management fee, which is taken out after the preferred return. So I want to highlight that because that's something that I have not seen across other funds. From a leverage perspective, we are targeting deals with around 56% LTV up to 75% LTC. You can see the average in the portfolio right now, 56% LTV, 72% LTC. Total loans under management is just under 1.4 billion, AUM just over $1 billion, with equity commitments, meaning investor commitments and contributions, just over 500 million to date. Going to the waterfall structure, we do take a 20% performance fee with an 80-20 split thereafter, right? So you have the 8% pref, 2% management fee, 20% performance, and 80-20 split thereafter. Again, this fund has been around since 2014. It's an open-ended vehicle, evergreen in structure, and we have not missed a preferred return. We have been able to meet liquidity requirements and liquidity needs of our investors as they have requested them. There is no lockup on committed capital with 90 days notice for a redemption request. A little bit about the lending fund portfolio today. And this is something that we put out every single month, right? So you can see the lending fund history over here. As of that month, year to date, and since inception, our loan origination volume, right? So we highlight some of the great numbers over here in terms of our lending capabilities and what we're actually doing today. And I just want to highlight that not a lot of other firms out there that are doing ground up construction are really lending all that much today, right? We're an extremely well capitalized lender that are doing deals underwritten in today's economics. We're sitting in a great position. Typical borrower, right? You're seeing a flight to quality across the entire asset class today. So highlighting the type of borrower that DLP typically works with, from their credit score to the number of projects they've completed, average number of loans per borrower in the portfolio, so we mitigate any sort of concentration risk. These are all things that we highlight to our investors on a monthly basis, so that everyone is confident and comfortable with our underwriting approach and portfolio analysis.
With high quality borrowers now, there's kind of a sweet spot right now because banks are still trying to sort it out from the train wreck that a few banks had a year and a half ago, right? So we're looking at borrowers that probably are SOFR 150, SOFR 200 borrowers. We're lending at SOFR 500, 550. Right now is an amazing time to be lending money to high quality borrowers that many of them probably should be borrowing at banks. And, the banks just aren't open for business. So it's given us a great gap right now to push pricing in the lending fund.
Going to move on to just highlighting what the actual returns have looked like. Again, you can see the net total return up here on the top, and then the annualized monthly down here, which is if you are taking the actual cash distribution. So you can choose to reinvest, or you can take the cash distribution to your bank account on a monthly basis. So double-digit net yields each year. Loans originated, again, we're sharing this with investors on a monthly basis so you can see what new deals are coming into the portfolio, as well as the back end, right? Every lender's goal is to be paid off on their principal, right? That is the theoretical format of any lender, whether you're a bank, private lender, you name it. We want to get paid off on our loans. And we are happy to say that we have never taken a loss on principal. We are still seeing the churning of capital throughout the fund, while other funds out there are just simply not seeing those payoffs come in. We do share this with all investors, and we are proud to say that we are getting payoffs regularly. And then lastly, here's our team. So we are always here to answer questions and help anyone out. Jump on a call, meet in person. We're an open book. And with that, we are happy to move to Q&A.
Okay, guys. So let's start off with the first question, and I'll throw it to you, Paul. What's the first question you got for the guys?
Nick and Drew, thank you so much. It was very insightful, concise presentation, and impressive. First question I have is, in the webinar, it mentions that the lending fund will originate loans to DLP's in-house development projects. And without referencing the names of the different funds that make up the capital stack, I'm just curious as to, is DLP lending to itself on these projects? And if so, is it in the form of ground up, brand new acquisitions, so to speak, or is it rescue capital potentially from loans that exist in the housing fund today?
Yeah. So no, it's not in the form of rescue capital or anything like that. It is of the same economics that we would get from another lender out there. Maybe we just feel that, it's better for us to take this deal because it's something that we can finance ourselves. And we're quicker withdrawals than another lender out there might be, as well as getting that deal underwritten, right? Maybe we're just not finding the right economics, from another lender, or they're just simply not lending. So we do have everything, tied out to a T in terms of legality of all of it. It is all structured in a way where investors can see there's full transparency of whatever loan we've done to the other funds, whether it be the housing or building communities fund. It could be in the form of ground up construction, could be in the form of bridge. It really just depends on the deal. And, it's not to save or, be, the loan is executed in the form of rescue capital by any means.
In the lending fund, we're really looking to do business with great sponsors and lend to them. We're not really looking to lend to ourselves. It's permissible, but any affiliate transaction is done at an arm's length. And then we're audited by Colm Resnick. And so everything that we're doing is extremely transparent. There's times when it might make sense, but really our focus is not lending to DLPs, other funds. Our focus is really on these amazing sponsors and doing multiple deals with them. So, the one thing is when you take care of those sponsors, when the banks do open the window back up, we want them to stay with us. We want to be able to have some pricing power because they know the kind of service and the turnaround times and the way that we work with them. So the focus is not lending to our other funds.
That's great. Thank you. And just as a follow-up to that, if investors wanted to get a copy of the current loan tape that would reflect some of that information, is that something that you would provide?
Yeah, 100%.
And to follow up on that, what's the rough percent of loans I'll say keep in-house loosely to DLP projects versus, third-party sponsors? Sounds like the majority of third-party sponsors.
Yeah, maybe 10%, Chris.
Okay, for in-house DLP?
Yeah, because it's just not our focus. Actually, we had an event for our sponsors in Asheville, bringing some of the biggest sponsors in the country together. And that's who we want to pour into. It was just before the hurricane, by the way, which was super crazy. But we had a great event there with, top tier sponsors. And that's the focus of the fund. We have the ability to lend to ourselves if we want to or need to, but it's all transparent, disclosed. But the focus is the kind of sponsors that we're working with. And some of those sponsors occasionally will have a project that needs some rescue capital. So we've been able to come into some great projects. We had one that actually had been defrauded. Their escrow agent ripped them off. It's a crazy story. And we were able to come in with that family and do an amazing deal with them. And then, we'll probably be doing 4 or 5 more deals with them in the future. So we want to have repeat customers that we stay very close to that are top tier. That's the focus of the fund.
I love the mission of helping affordable housing and all of that. And you guys try to lend to projects that keep rents to less than 30% of area median income, you said. How does that fit with, you're talking about high-end assets and working with the best operators. And it's so hard affordable housing is difficult. So how are you kind of doing both, getting these great high-end assets, but also keeping rents low enough that it's affordable for people? They seem to be competing goals.
And it is a tough market to do that because affordability's, never been in a harder situation, but that's what's, harder than affording rent. It's affording home ownership. So the spread between owning a home and renting a home has never been higher, even though rents have continued to go up significantly. For us, I think affordable housing, a lot of times when people hear affordable, they're thinking, government assisted, Section 8. Okay, that's not what we do. We're doing attainable housing for working people. So in an area, if the rent's $1,800 a month and the household has $92,000 a year of income, they're going to fall into that AMI in that particular area. I'm thinking of one project we have in Kissimmee, Florida right now. And so they'll fall within AMI, but it's people who are working. It's really more workforce housing. It's nurses, it's firefighters, it's professionals that are in rental communities. And that's why you can have Class A and have the kind of, quality that we have, but still stay within under 30% AMI in that area. So it's not affordable housing in a government assisted sense. It's attainable housing for working people.
Yeah. And just to highlight that, right, Jim? So the income that we're actually delivering to investors, if it were affordable housing, you would take those tax abatements that are offered by municipalities and the overall arching government of that state or area, that would hit the NOI, ultimately resulting in less income, right, to investors and a less of a valuation of that asset. That's not our focus, right? Attainable housing for workforce American families that can actually afford the rent. And that 30% AMI metric is something that we use to measure the fact that we are delivering an impact in terms of the assets that we are lending to or even acquiring, as well as making sure that we are delivering on our yield at the end of the day to investors, and they can expect that double-digit annualized net yield at the end of the day.
Excellent. Thank you for that. Chris, you got a question you want to jump in with?
So I am looking at your July lending report and just going through the income statement on there. And under interest expense, you guys are utilizing some credit facilities, $2 to $3 million a month in interest expense and $200,000 or $300,000 a month in interest expense to note holders. Can you talk about both those types of credit facilities and how you utilize them?
They're not any different than what you might have typically come across with other debt funds, whether it be corporate lending, focus, or real estate lending. Right? We are utilizing 2 warehouse facilities that operate as revolver structures where we can draw down on the line in order to fund draws or other capital requirements, and then pay down the line with payoffs that come in, as well as new investor contributions, right? It's a kind of like a credit card facility, if you will. We draw down on it. We pay it down on a daily basis. We want to keep leverage in check, right? We don't want to be too over levered. So we are managing that extremely diligently. And we have a full team that's dedicated to that as well. The note holders, that's more of a note on note type of structure. So those are individual investors that can invest in a note structure, a fixed note structure that is focused specifically within the lending fund. That is debt to the fund, but it is an investment for those investors where they can get that fixed yield on those products. It's just another product that we're offering investors that maybe don't want to be in a fund, but they want to, have a certain lockup within a fixed note. Think of U.S. Treasury, right? If you're looking at a 2-year or 10-year, something like that, we have a 3-month, 1-year, 6-month note. Again, those are payable notes in a note on note structure, and it is debt to the fund. It's not a whole lot. I'll just add, we don't have many investors that are allocating to those just because the fund itself doesn't have a lockup and does have a 90-day notice for redemption. So, if you're looking at the value add there, most folks will ultimately end up in the fund versus those notes. Can
I jump in real quick just with a follow-up with the 90-day redemption? Can you talk about what's the average time for redemptions, and has it ever been more than 90 days? Because with some of these funds, especially during COVID and the pandemic, they say 90 and it's 900 or something. So can you speak to that?
This is another place, Jim, where that investor centrism comes in. When we get redemption requests, I think the longest that we've taken to pay one is 54 days. So we pay out our redemptions. Usually we pay them out earlier than expected. For example, with the 2 equity funds, they're open once a year. With the lending funds, they're open every 90 days. And when we hit that redemption window. Of course, all the funds have had more inflow than outflow. All of them have. But when we hit the redemption window, we paid out within 3 weeks. So it's not something we don't want to sit around in cash. It drags on the fund anyway. So when you get a redemption request, you honor it pretty quickly. But we have 90 days. And then, you have all the gating provisions if you needed to with the fund. If there was ever a run, you have orderly withdrawal. The other thing that you think about with the lending fund in particular, one of the reasons when I was diligencing it that I liked it was the duration. So, you're at a duration of like 18 months on the fund. And so, you think of every 90 days, probably 15%, 18% of the capital is coming available. What that tells you is that with that short duration, if there was a liquidity issue, that the longest people would have to wait, is 18 months for the full fund to be redeemed, maybe a little bit longer than that if there were some straggler loans that had to be worked out, right? But that's one of the things is you've got 90-day liquidity, but you've got a duration of 18 months. And so that's turning really quickly and provides for a really liquid fund. And so we never had an issue with paying a redemption at all.
And to highlight that, right, I think that that's a very, very key point, especially in today's market where you do have other funds that are lending at 18-month durations in terms of their loans, right? Short duration, it's a risk mitigant for sure, by all means within a loan portfolio, but they're not seeing payoffs come in, right? As rates have gone up, you've seen cost of debt go up, you've seen cap rates go up, and thus valuations of real estate assets are coming down. When those folks are looking to refinance that debt, those borrowers out there, they can't get a refi by agency debt, right? And so Fannie and Freddie are looking at maybe taking out 60% of the loan when they need 70% LTV, right, taken out. So there's a 10% left over that they're not able to refi in terms of that debt. Within DLP's portfolio, we're not seeing that problem. We are seeing full payoffs. We are seeing slight extension of loans, but we're not modifying any loans. We're not restructuring anything. Our borrowers are really performing. They're on pace. They're following everything in terms of timelines that are initially set up within their Gantt charts. And they're refinancing us with bridge lenders out there that are still able to lend where their portfolios are not past 90% LTV. So we're seeing a nice flow and a nice churn of capital here within the portfolio, thus our ability to pay out those redemptions.
Personal guarantees as well. So high quality sponsors with full personal guarantee.
Nick, Drew, you guys mentioned that there's a lack of supply in the market as far as lenders participating in the space today due to what we all know has happened over the last few years. And with that, there's still demand from borrowers. So that creates pricing power in the form of originating loans that have a higher interest rate. And I understand that. And I'm participating myself as a passive investor in some funds that are special situation or short duration, time sensitive needs from the borrowers, and they can command pretty high pricing power for that. You guys are doing more traditional loans. And just as a little context, I have a sponsor I'm connected to here in town that's about to embark on a ground up multifamily development. And they shared a term sheet with me and it showed the 5-year treasury plus about a 2.5 or 2.8% spread or so. So it was like into the mid sevens as far as their interest rate. You guys seem to be lending at a higher rate than that. How can you maintain competitiveness in the market if you're loaning to borrowers that have strong track records at much higher than that?
I don't know who that borrower is, but we're typically lending off of SOFR plus a spread, not the 5-year plus a spread. So SOFR right now, last I checked, it came down to, I think, about 4.6, right? 4.65. Prior to that, about 2.5 weeks ago, it was about just over 4.8. So, and that's typically the index that everyone's using to price their loans off of, right? And so we'll be, SOFR plus 5, 6, 700, 800 over. And so where we stay competitive is our ability, not only in terms of pricing, right? I think we're pretty standard within the industry, within the market, but also there are different things, right? If there's a little more risk in a deal, right? If there's maybe more than one phase within a deal, right? If there's a second phase and a third phase, well, we'll price it out a little bit more heavy up front, where it's a 2% origination fee plus SOFR, 800, 850. And then once phase one is completed, you meet a certain lease up threshold or whatever, any other parameters like that, maybe then we decrease the actual actual rate, right? And overall, when the borrower looks at the cost of debt to finance that project, it ends up being cheaper. Not every time, but in some cases, it might be cheaper than other folks when they're, going to other lenders out there. That's just one of the ways we stay competitive. Another thing is our ability to finance draws. We can move quickly. We can move a lot quicker than banks. We like to say it's a white glove service that we offer borrowers, right? Where other lenders perhaps maybe take a little bit longer. We do have the in-house construction team that will go on site and review the work that has been done to make sure it's actually being completed. And again, these are actual engineers, right? These are civil and structural engineers that make up this construction team. So what happens is they develop relationships with the borrowers. They can talk construction. They can talk timeline. They can talk issues. They've been through it. And, I think our borrowers at the end of the day, and a lot of other borrowers within this market, seasoned real estate developers really resonate with that. Because it's not just, oh, it's my lender, he's coming on site or she's coming on site. They're going to grill me on the work that's been done. It's, I have a great relationship with this individual. Let me tell them about any stress that I'm seeing, or let me tell them about the real, great work that I'm doing. And that attributes to faster draw next month.
I think, Paul, it's a good point. I think that banks are a bit congealed still. So to super high quality borrowers that have long-standing relationships with banks, the few, construction borrowers that banks will lend to in this market, good on them, right? If they've got that kind of relationship with the bank and they can get that kind of financing, that's great. But it's still rare. What I found from working with regulators is they're usually great at regulating for the last crisis. So it's probably going to be another year or so before the banks start opening the window again and getting serious about the deficit in housing that we have. That's the other thing is, this huge deficit is created because of the lack of willingness to lend right now. So if people can get those rates, that's great. There's still plenty of great high quality sponsors. They can't get there right now.
So personally, as an investor, I am not a fan of the Florida market. I think it just has a lot of headwinds in general, kind of coming towards it. Can you talk about what type of safeguards you do in underwriting for proper insurance and, income coming in, and maybe with, the last round of natural disasters, like how has that impacted or not impacted your properties and your lending portfolio?
For us, when you think about Florida, the places that are the most high, the highest concerning place in Florida is South Florida, right? So we're not really in South Florida where, you take the direct hit. I'm from Miami originally. I remember Hurricane Andrew. I've seen what, bad storms can do. I think that's priced in the insurance, which is really tough, especially in South Florida. We're more in places in North Florida on the Space Coast. So we're not in, that prime area where you could get hammered. Look, insurance rates are still high. It's something that has to be managed. When the storms came through, we took a little bit of damage with some of our units in Kissimmee and Space Coast, but everything was up and running. Actually, the worst damage we took, surprisingly, was in Asheville. We just closed the week before the hurricane hit Asheville with a Class A property called Asheville Exchange. It was built in 2017. It's great property. I think there's 312 doors. We got it at $246,000 a door. It cost us $312,000 a door to build. And so we're super happy with it. And a week later, the hurricane went through. Our residents didn't have water for 3 weeks. We trucked in water. We took care of every one of our residents. We're getting 5-star reviews for how we responded to them. That's just kind of who we are. So it's kind of surprising that the worst hurricane damage we took was in North Carolina.
Great. Thank you.
Are there any projects that you guys lend on where you make up the entire capital stack? And what additional risks might that pose an investor? Or just what's the biggest risk, I guess, you would identify for investors in general with the fund?
There's none that I'm aware of where we make up the entire capital stack, but I will speak to the risks, right? When we're looking at the lending fund, there's always the risk of repayment. That's the number one. And so when I'm looking at an investment in private credit, I'm looking at the ability to perform, the ability to get repaid. It's easy to lend money. It's hard to collect, right? And so what I look for is a track record of the ability to get borrowers to perform. And look, not every loan in the lending fund is going to be a cakewalk. Some of them take real work. Some of them take working with the borrowers. You're not lending at these rates. You're not getting 10% or above, like there's a free lunch somewhere. There's not. If you had to look for an alpha thesis, which every chief investment officer will look for, it's being smart, understanding the industry, and putting in the hard work. So to me, the biggest risk is, the loans performing. And if people make a bad loan that doesn't make sense to begin with, working out of it, it just doesn't get better over time. So to me, being that credit committee and the investment committee are essential in this process. And it's probably a strength of the firm.
Some of the components of that, right? When we're underwriting, we're looking at underwriting to certain parameters, right? Compared to pre-2022, right? If you were underwriting in 2021, maybe we would have done, $15-20 million loan, LTV upwards of 65-70% LTV, LTC max of 75%, right? We're still at the max 75% LTC today, but we would have given a little bit maybe on the DSCR ratio, right? Today we're underwriting at a 1.25 and we hold firm to that. We can be creative in certain regards with certain borrowers. And we do see, certain loans where takeout lending is only going to take out up to a 1.2, right? DSCR, right? And so we can be creative about that excess. Other things in terms of the quality of borrower, we're not going to really budge on the credit quality, right, of the sponsor. Things like that. We're underwriting to 7 or 8% debt yield. Yield on cost, right, has to be there. There are certain things we won't budge on, and then certain things that we can be creative with, in terms of the overall underwriting. And obviously, every lender's seen the change from 2021 to where we are today. It's about adjusting. And again, I'll just hammer home, I think, being a well-capitalized lender in today's environment, not just seeing, okay, you can make a lot more money doing credit investments in today's environment, right, in a high rate environment, but that being a core focus of ours since 2014, again, being well-capitalized and underwriting in today's economics, I think is a huge, huge component of being successful. And again, it's been a core focus of ours. So that's the last thing that I would just kind of put out there and just to wrap that up.
And the risk mitigation for us is, when I'm sitting in investment committee and we're looking at a great deal that we did in North Carolina for one of our sponsors. But I got to tell you, in the back of my mind, when I'm looking at that deal, I'm thinking, I don't want to own it, but if we end up owning it, I don't mind. When you're underwriting to the same standards that we would underwrite to own something, it just puts that safety net underneath the deal for us. One thing is that DLP's never failed to hit a return target for any fund for any time period. Now, will that always be the case? No, I can't promise that at all. I'm just saying that there's been a consistency and a willingness to be an investor-friendly firm. And it's one of the reasons I came here.
Excellent. Well, Nick, Drew, thank you very much. This has been very enlightening. And Paul, Chris, thanks for the great questions. So we're going to pause right here and say goodbye to Nick and Drew. And then Paul, Chris, and I are going to chat about the deal and tell you what we think. So thank you very much. And thank you to DLP for being a supporter of Passive Pockets.
Thanks, y'all.
Thanks, everyone.
Well, that was great, guys. Great questions and loved hearing their answers. But now is the time where we can kind of dig in. Mom and dad are gone. Now it's just the LPs playing in the backyard, right? So we're gonna talk about what we thought of the deal. Now, just for everyone listening and watching, we are not going to make any recommendations in these deal review webinars. We're going to try to provide you with all the content you can, all of our opinions, but in the end, you need to make your own investing decision. So we'll give you insights, the opportunity. If you're considering investing, come to your own conclusion. So the first thing I like to look at when I'm looking at a deal is generally, what do we think of it? And do you see any red flags? So Paul, I'll start with you.
I don't see any red flags necessarily. I mean, there's a lot to like about the sponsor's track record. They've been around since 2014. They've stated they've never missed a preferred return payment. They're mission driven. They seem to have a very ethically rooted approach to the business. Don Wenner is a very impressive guy. I actually have his book, and I'm more encouraged to read it now. It's been sitting in my stack of 20 books for a long time, and I'm getting closer to it as the days go by, but it's called Building an Elite Organization. I'm not an investor of DLP. I would certainly consider investing and have some more due diligence to do, but that is a place where I would start with reading his book and kind of getting inside of his head. I also had a chance to sit next to Rich Delgado, who's a managing director with DLP, at a conference over dinner, and was really impressed with him too. It seems like everybody from the organization is cut from the same cloth. I don't see any real red flags, so to speak. But I will say I'm not crazy about the line of credit, the warehouse facility they draw upon. Of the lending funds that I'm involved in, the loans are originated just from the equity that's raised from investors. So I'd want to understand a little bit more about that. Chris, your question, you touched on that. I want to dive into that a little bit more. And certainly if I were going to invest, I'd want to read through the PPM and the operating agreement and find out exactly how that works and what parameters and restrictions there might be on that.
What questions would you ask about the credit facility? So that's a little bit different than other debt funds. So how do you dig in and figure out, hey, what should we ask?
Well, there's a lot of lending funds that use credit lines and use leverage to enhance returns for their investors or smooth out volatility on those returns if they don't have the cash to meet their obligations to their investors. So I don't know if it's anything different. It might be. We'd have to look deeper. But I just want to know kind of how much leverage are they using and what risks are associated with that leverage. Is it floating rate? What sort of covenants do these lenders have? Because really, when you think about if you're in the senior position as we're being advertised we will be, but then leverage is being used, we're not actually being paid first. It's the lenders on those credit lines that are being paid before us. So at least that's my understanding. So I'd want to understand that relationship a little bit more and what risk it might pose to us as investors.
I agree with Paul's overall comments. Great track record. I'll add on some things on there like they're diversified across different asset classes, geographic locations. And they're a big fund, at least in my book. That's a big fund for a debt fund. I like that they are a REIT status. I'm assuming that will have some of the preferential tax treatments when, the monthly distributions come out to the LPs out there. And I agree with Paul. I could have spent the whole show just talking about their credit lines, but that's, I think, too deep of a dive into it. I like debt funds that use credit lines, as long as it's used, smartly. I use leverage in pretty much everything I do in my own investments, my own business. So I'm very comfortable with it, as long as it has, the decent guardrails on there for not too much leverage. And of course, how they stack it in. So I like the leverage aspect, as long as it's used responsibly, because we do get better returns on there. My two biggest cons on there, one I mentioned is I'm just not a fan of the Florida market. And for a debt fund, I'm in some debt funds that have an asset, AUM fee, and some don't. They just kind of take their fees off performance. I like to see less fee-heavy funds where it's more just they're taking kind of like a rip off the interest is how I personally like to, I think it aligns things more. But end of the day, both those concerns I have with fee structure in Florida, you look at their track record, if they're pushing out 11 or 12% annual returns, end of the day, they're hitting the numbers. So, it's less concerning to me. But I personally like to see debt funds, especially in this day and age, paying 10% or more. And, this fund definitely fits that 10% or above threshold for me.
You talk about the fees and you'd prefer them to take part of the profit, I guess, rather than charge the fees. Is there any way to know? They're probably doing both, right? And I'm not saying that's a good or a bad thing. You want them to get paid adequately. And if you're getting paid adequately and they are, then that's a good partnership. But how do we find out? Like, are they taking a fee, a management fee, and then, also taking a piece of the profit?
Yeah, from my understanding, reading one of the documents off the PassivePocket websites, they were taking a 2% AUM, so 2% annual fee. And then I think once they hit the pref, they're taking their 20% performance fee. And then it's an 80-20 waterfall is my understanding of it. So again, that's just how they structured their fees. And the day, if they're hitting numbers and they've never missed a pref payment, I really shouldn't care at that point.
Can't quibble on that then, right?
Yeah. If they're delivering the results, who cares about the details in between? So I said, that's just, one of my personal comments. But in the day, like if they're hitting the numbers and everything else checks out, that's not going to be a deal breaker for me.
Yeah. A couple good points by Chris that I would expound upon a little bit. I do like the fact, even though they are taking an asset management fee, that it's taken after the pref is hit. A lot of times you think of a preferred return and usually it's a preferred return and then the waterfall follows the preferred return, but the fees are taken on the front end. So it's almost like they don't count towards the pref, right? In this case, they're going to pay the pref and then they're going to take their 2%. So they do align interests a little bit better than most sponsors might in that situation. Chris, you also touched on the credit lines, what I mentioned about the credit lines before. And I think you make a really good point about just smoothing out returns. I'm in a fund right now that does not use leverage. And while that feels safer, it does create more volatility because they're constantly raising capital, but they don't always have a chance to deploy that capital when more capital is coming in the door. So that leads to cash drag, and cash drag leads to poor performance or less performance than you'd like. So I think those warehouse lines can be used prudently. It's just a matter of identifying how they are being used and kind of like the guardrail comment, Jim, you made, that was spot on. So, but all in all, I like too that they don't have a lockup provision, because it's almost like a high yield savings account from that standpoint, with more risk, of course. But you're getting your yield, you're getting your dividend payment. And then if you identify an opportunity in the marketplace or the macroeconomic environment changes such to where you want to rotate into something more aggressive as far as your allocation is concerned, you just contact them and you can pull your capital out. In an ideal world, of course. But it seems as though they've been able to hit those gates as far as redemptions are concerned and not had a problem doing so. So I like it as kind of another option to put cash while it's sitting idle.
Right. And, some of these debt funds, we've had issues with redemptions where they say it's 90 days and I made a joke, it's 900. Well, there is one that's been similar to that. So how much do we look at track record, right? Because they've been doing this for 10 years through boom times, through COVID, through the difficulties we've had now, and the returns have been very consistent. One question I didn't ask but would like to is, should the returns be higher now when interest rates are higher and times are more difficult than they were, in 2019 when interest rates were nothing and every bank was lending on everything? Just talk a little bit about track record and how you factor that into this type of deal, because it seems like track record is more important than anything else because it's not a specific deal. It's just a bunch of loans.
Sure. Well, I agree. I think track record is the most important thing. And your question there for about, hey, should we be seeing higher returns with a higher interest rate environment? I've asked that to numerous debt fund operators, not DLP, and the answer I usually get is basically a no. I've not seen that correlated across any of my investments, other than I like the general exposure right now, in the marketplace for kind of like being the bank or being on the lending side. I really like that from a macro investment. I have a good chunk of my money in various debt funds. So I really like the track record. And what Paul talked about, like their liquidity redemption is pretty stellar compared to others. I mean, hey, they're pushing 11 or 12% return and a 60 to 90 day redemption. That is, I'd say, better than a lot of other funds I see out there. I agree with that. I always like to be wary on redemption periods, Jim. I'll get it back in this amount of time frame. It'll be double, just like whenever I do any projects myself at home, it's double the budget, double the time. But the fact that they've been able to do that is a really great aspect to me. And I definitely use credit funds as like part of my, longer term emergency and longer term, liquidity for investments. But a lot of them, they're a year or two lockup and then there's some rolling redemption. So them being, I'll say a 2 to 3 month redemption is just not normal in the industry. So I really like that. And based on a track record, I would feel pretty confident in getting within that range.
I would agree with everything Chris said. I think track record is paramount, and they've obviously got a stellar track record from what we see on the surface as far as what's been presented to us. I don't know what they were paying in interest back in 2017 and whether it differs from what today looks like in the interest rate environment we're in right now. But I really like debt funds. Debt funds have been pretty much my primary strategy as an LP for the last 18, 24 months as we've been in this sort of strange period in the market cycle and haven't really gotten excited about many equity deals out there. So I certainly like what they're doing, and I don't have any hesitation in further exploring. A lot of times when I look at deals as an LP, I'm looking for a reason to say no very quickly, right? Might be the offering memorandum. It's 5 minutes into it, and it was like, these returns look great, but they're just not realistic. So I don't even need to look further because I know this is not reality. And then other times I get into, conversations like this with myself basically. And, I ultimately decide that, risk return profile is just not really there. There's not like an asymmetric imbalance as far as the risk and the reward goes. So I kind of say no at the end of the day. But in this case, I think this is one where it's like, I feel like I could look a little bit further and try to dig a little bit deeper to identify maybe where this might align in my portfolio.
Additional question. So if this was just, a normal way I would look at a deal, I'd watch the webinar, then maybe I would call up the operator and have this type of conversation we did where we ask a bunch of questions. And then when I'm done, I'm going to find more questions to ask them and maybe send in an email, partially to test their communication, but also just to see, are they going to respond and with quality responses? So we didn't get all the answers we were looking for. One, we didn't get the PPM. So I don't know what that looks like. Obviously, that's one question we would have to ask. There's a couple others that I might ask, like as we said, returns have been consistent and shouldn't they be increasing? I would ask that. They lend to experienced developers, builders, and operators, they say, but how do you evaluate that experience and track record? So what kind of other questions do you think you guys would ask if we had unlimited time with them, or you just wanted to send them a note and say, hey, I got some additional questions? I
would go into the PPM. That's the next step, is really to get into the deal documents and read through. The PPM is a comprehensive document that should outline all the risks that are, going to be potentially in front of an investor. So I'm sure some of the language in there, it's a legally written document. There's some jargon in there that you would come up with some additional questions, and I would just pull stuff from right out of the PPM and email it to the sponsor.
I would do the same, and from the high level, like it passes a sniff test. Hey, digging deeper. I agree with your guys' philosophy. That's where you come to the PPM, because ultimately that's what matters, not what the IR reps say, but what's we all know what's in the PPM is what matters. So dig into that, and then I would do my questions from there. But as far as like peeling back the onion, looks attractive and looks like it's worth digging into more for sure. If I could ask him a lot more questions, I would love to spend more time on how they're utilizing the credit lines like we talked about. And I'm curious about how they handle foreclosures. I think their portfolio is like 2.2% foreclosure rate, which is pretty, normal for the debt industry there. But they said since they have the vertical construction and sometimes they take over projects, I'm very interested in the mechanics of it, because while that might be good to save the deal, I'm curious what it does to the timeline for getting the capital back on the deal, and then how that deal is ultimately exited, how any potential profits are split from there as well. Because this is the first debt fund I've seen where they've had like a vertically integrated construction arm that could take over a project. So I'm very interested in those mechanics. Because usually it's just about the speed of unloading the property and just getting the capital back and move on to recycle the capital, at least from my understanding.
Yeah, that's a huge advantage, Chris, that you just outlined that construction team, not only for their housing fund sitting higher in the capital stack, but just for originating loans. It sounds like that team is involved with the borrowers and kind of has a better understanding potentially than a traditional bank lender might, as far as the process and where they might be. So it allows them to get a little bit more creative potentially and who they target. But I'd really want to understand how they evaluate the track record of their borrowers too, and not just take it, hey, here's our best borrower that's, done, 50 deals with us. What's the methodical process and how they evaluate somebody that's new to their ecosystem, and kind of understand their mindset around that.
And Chris, let's assume that the deal checks out and everyone does their deep dive and they're like, yeah, this looks like something I may want to invest in. What type of investor would this deal make the most sense for?
Oh, geez. I could run the gamut here. I think it makes sense for, we talked about this during the BP con as we were playing avatars, Jim. I think I like the investor that has recently left their job and they want that consistent cash flow, whether that's an investor that left their job or maybe someone that's more like the retirement age. A lot of people just that want that consistent cash flow. So I think that would be very good for that type of avatar. The second is kind of, I think, what Paul and I were talking about for people that want a place to park some cash to where, hey, it makes sense the current market cycle. I would consider it relatively safe. And then also for real estate, 90-day redemption is highly liquid. And then, hey, you can pull that money out to go redeploy. Because I'm like, Paul, I've shifted more money the last 2 years to credit investments than I ever have. And then, with the idea, hey, it's a great play right now, but as I see opportunities, I will pull out some cash to deploy into some, typically multifamily deals for me. So I think the people that need consistent income and people that just want to be opportunistic with where they can essentially park their cash.
Yeah, I think this is great for the person who has a self-directed IRA or a solo 401k as well. The interest income is going to be taxed as ordinary income. If you do it inside of a qualified account, you'll be able to avoid the income taxes on this type of investment.
Last question, we got to wrap up here. We talked about DLP is a little bit different because they, in some ways, they can take over the deal that maybe goes bad. So that's one thing. But what are some other things that makes DLP different, you think, from other similar offerings, positive or negative? I know we covered a little bit of this, but just kind of summarize what makes it different.
I would just go back to the track record. I mean, they're pretty big players. You've seen a lot of credit funds that have popped up over the last couple of years because of where we are in the market cycle as sort of an opportunistic play for these sponsors, new ventures, providing liquidity to a market where it's been constrained. These guys have been doing it for a long time. And it seems like their transparency is very high. They said they would show us the loan tape. They've been very upfront that they lend to themselves. And some of the things that maybe you don't want to hear, they're saying, hey, don't call us out. We're going to tell you we do it, and here's how we do it. So I like that. And I do tend to, even though I've not met Don Wenner, I've heard him speak a couple times. He's obviously got this book that I'm going to read here shortly. And I just think they have sort of a impressive mission-driven sort of organization. So all in all, very impressed.
All right. Well, we will expect a book report to be posted on the forum by the end of next week. So, Chris, you have anything to add to what Paul said?
Well, I'm eager for the book reports. So I agree with what Paul said. Something else I'd add on there is I did not get to ask him a chance about how their REIT status may impact how their distributions are taxed, because to get very nuanced here, I hold a lot of the debt funds and actually my solo 401k for the reasons you said, Paul. And then there's a couple I've invested in non-retirement accounts that have REIT status, which tax a bit more towards like capital gains income versus ordinary income. So from a very nuanced level, I kind of split up my items that way. That way I can stay a little more liquid. And I try to put the REIT funds, which usually have more favorable tax advantages, in my non-retirement accounts. I like the fact that they're a REIT status, and also just their liquidity and redemption period is very attractive.
Perfect. Well, thank you both. This has been awesome hearing your extra kind of ideas about the deal and just having this time to chat as LPs, as I said, without the operators breathing down our necks. So thank you very much. We appreciate you being here with us.
Thank you, Jim. Thank you, Paul.
Thanks, Jim. Chris, it's been a pleasure.
And that wraps up this deal review episode. A big thank you to Nick Stonestreet and Drew Weinstein from DLP Capital for presenting their deal. And of course, to my fellow LP panelists, Paul Shannon and Chris Lopez, for sharing their amazing expertise. We hope this episode gave you valuable insights into what experienced limited partners look for in a syndication deal, the questions they ask, and the factors they consider before making an investment decision. If you enjoyed this webinar, be sure to like, subscribe, and leave a comment with your thoughts on the deal or what you'd like to see in future deal review episodes. And don't forget to check out PassivePockets.com for more tools, resources, and of course, a 7-day free trial to join our community of passive investors. Thanks for tuning in, and as always, happy investing.